Good morning, good afternoon, and good evening, wherever you're watching. I'm Matt Gougé, Matt the Mortgage Guy. I'm joined by Nash Paradise, the Loan Wizard. A couple of guys who are actually doing the thing, talking about the thing, that thing being real estate and mortgage, and everything involved. And the reason I had to start like that, Nash, is because more and more, if you consume content, you've got to be weary of somebody selling you something or talking about something that they don't have actual experience in. I got this little twinge in me because there was somebody who was talking about, mortgage related stuff, never have written a mortgage in his life, talking real estate. And the guy really didn't have any practical knowledge of what's going on in real estate. So just want to clarify for everybody. This is what Nash and I do all day, every day. We do this morning, evening, when we're, on vacation and whatnot. So we've seen a thing or two. We might know a thing or two. End rant.
Yeah, you can work while on vacation. I'm going to take some time off when I go there. But yeah, to your point, we're definitely in it every day. I have also seen an uptick in information, especially as we get closer to Fed rate drop in September. We're going to keep seeing news outlets reporting things that are interesting. Had some links sent to me this weekend. I guess an article hit Yahoo about, Fed dropping rates, but don't expect mortgage rates to follow. This author happened to be correct. So it's nice. You got about a 50-50 on whether or not that content is going to be accurate and in line with what we expect to see. But, our 30 plus years of experience in mortgage lending, tracking rates, knowing how these things are going to affect us on the mortgage side, but also real estate as a whole, we're going to bring you what we know, and hopefully you can be best prepared with talking points. And, let's dive right into what happened last week. Last week was scary. I told you I was scared. Monday was an interesting day, and it absolutely did not disappoint. We got the huge news last week. Showed up on Tuesday. We had core CPI. This is, your consumer price index. This is what people are paying for things. And the core, they end up pulling out food and energy because those are more wild on the swings. And, we did not get what we expected. We had, we'll call it mixed. The year over year core CPI in July, we were previous at 2.9, forecast at 3.0. We ended up hitting at 3.1. So missed a little high. The month over month, things surrounding wound up flat. But what's interesting is the headline CPI. This is what was funny when you were consuming content last week. Inflation is down. Inflation is down. Okay. Depends on which one you want to look at. So the headline was down. It went, 2.7 last month. 2.8 was the forecast, and it came in at 2.7. Again, little help with rounding on that one. But the reason it came down is we had, lower prices in the energy sector, and cool. So you got a mixed bag, mixed data, which is good. That could have gone really, really poorly for everyone, but instead we stayed pretty flat. Looked like it was going to be a smooth week. All the jobs reports on Thursday came in about as expected. And then what did we have hit last week that was unexpected? Oh, core producer prices, this PPI index on Thursday anticipated to come in at 0.2%, came in at 0.9. The year over year expected at 2.9, came in at 3.7. Oh my goodness. Thursday was not a good day for mortgage rates. It showed that some of these sectors, inflation is a lot higher than anticipated. To have a month over month inflation rating at 0.9 versus a 0.2, it was not good. And I feel like we've kind of been reeling since then. Let's take a look at how that's going to impact this week. We'll get into what happened to interest rates a little bit late last week, but this week is, what we call a nothing burger. There's a lot of not great data that's going to help us much. A couple decent meetings going on. We've got the FOMC minutes. That's the Federal Open Markets Committee is going to be talking on Wednesday. There's a Jackson Hole Symposium on Wednesday. And on Friday, Fed Chair Powell is going to speak. So we got a lot of people talking about a lot of things. And, Powell doesn't like to give any major indicators one way or another. And had we just been coming up off of the revised jobs reports from a few weeks ago, I feel like we would have liked what the FOMC was going to have to say. But now that we had those PPI figures last week showing certain segments of inflation is going the wrong way in a hurry, I think it's a mixed bag. I don't really know what to expect from the Open Markets Committee. I don't know what to expect from Powell. And I think we're going to see a pretty interesting week of, bonds responding weakly to what people are saying. What's your take, Matt?
Yeah, I mean, after last week, I think there's trepidation is a big fancy word. I don't even know what it means. In my world, at least, because rates came down, everybody's excited, but there's so many different things that can affect it. And I feel like they're sensitive, more sensitive than normal, and so. Yeah, to your point, it'll be interesting to see what comes of this Jackson Hole meeting, but not expecting Jay Powell to say anything, earth-shattering that's going to move the markets a ton. I'm on pins and needles a little bit with rates because they come down, and the human psyche is such a powerful thing, man. Like, people just expect it to go lower, whether it's a refinance conversation I have or somebody who's in the market to buy. It's like, oh, they went from 6.75 to 6.55. I'll just give it another 2 weeks or 4 weeks and we'll be down to 6.35. Maybe I'll wait 3 months. We'll be down to, 6.2. And that's just not how it works, right? We know that. We can try to explain that, but the human psyche is undefeated with thinking if things have gone well, they'll just continue to do so.
Yeah, I mean, I understand that. I mean, we all as loan originators, mortgage brokers, and people in real estate, we want to see trends. We're used to trends. You watch trends in housing, you watch trends in real estate, you watch trends in design. Like, things start going down a certain path and you expect that to continue. And unfortunately, what we lack right now is a firm foundation. In fact, I'm going to go one step further and say we are hanging on glass at the moment. The fact that we have mortgage rates and the overnight average where they are, and the 10-year treasury yields where they are, this is not good. This is not stable. We need a much lower 10-year treasury yield to hold this position and these rates. And I see the bottom falling out of this. And without any major news or major economic data, major, indicators in the speeches this week, we're going to see mortgage rates continue to slide up. It'll be slow and steady. I mean, we've already lost 13 basis points this morning with no news. The market is just selling off on bonds. We started under 430. Now we're at 434.8. Like, it's just the 10-year treasury yields really do not want to break and hold below that 430. And again, the last time overnight average interest rates were this low, we were around 4.0 on the 10-year treasury yield. So we're like 30-something basis points high. It's just a recipe for this not to hold. And for anyone that likes what they have right now is to protect it. I know before we jumped on this call, I had a refinance I'd pitched over the weekend, got pricing opened up, went ahead and just quick locked it as fast as I could because I'm just not real hopeful about what this week can bring. Let's talk about the Fed. Let's talk about where rates are going. And this Fed funds rate tool has been very, very neat. This is a composite index that's aggregated based on percentages of changes. It's a lot of big fancy science words for how likely is something to happen? And we know that it is a foregone conclusion at this point. Everyone is anticipating and expecting a Fed rate drop in September. So you can see that 85% sure. That certainty has gone up into the mid 90s, down to the mid 80s. It's about as weak as it's been for a while, thanks to the PPI numbers last week. The interesting thing that I have been watching personally has been, are we going to see back-to-back drops? And right now, 61% unlikely. It has been on the other side, it's been 55, 60% likely. So, talking about trends, we are trending in a bad direction. If we are trending for 3 rate drops this year, that is good. That means inflation's under control. That means jobs, the economic growth is stymied, to the point that we want, just slow growth. And when we get more and more away from that, when the percentage of drop for October moves, that's telling bond traders a lot. It's telling UMBS securities traders a lot. And so that's what we are tracking on this, is which direction are we moving right now? We're moving away from that second drop. We're still looking second drop this year in December, but it's just telling us, hey, be careful, because as we're moving in one direction, like we want to get into a direction, hold that direction. Right now, we're moving the opposite way.
Yeah, if you're betting on 3 rate drops by the end of the year, looks like that's gone all the way down to 18.21%. So you've got a better chance if you're all in on the turn with an open-ended straight draw and hold them. That's about a 1 in 5 shot. It's about 20%. That's a better shot than 3 rate drops this year by the Fed today, right? This stuff changes quite a bit. That's something people need to remember is, this 85% that we're getting a cut in September was up above 95% just last week before the numbers Nash discussed. So we'll continue to keep you guys updated, watch this, and see how it progresses.
Yeah, so let's talk about where interest rates are. I know we've briefed on it a couple times. We've been squiggling around here, and I know that we've been really happy to be further away from that 6.75. We've been on that 6.75 average since March of this year. It's been a little up, little down, a little up, little down. And, it feels like we've broken closer to that 6.5. We're not real close to getting underneath it. And again, we're moving the wrong direction right now, but I'll say we kind of have a little bit of padding as of this morning, 6.59. And, that's a nice, comfortable spot. Breaking under 6.5, I think, is going to take a little bit more work again in the treasury bond market. But being here, sitting here, the same people that had affordability a month ago have affordability now. The same refis that made sense last week, still probably hanging in there. The severity of the changes, you look at every time we've dropped down below a mark, hasn't held very long. It didn't in December of 24. It definitely didn't in April. We've been holding a little bit longer. So I think anyone in real estate just needs to be grateful right now that we've had a good few days, a little over a week with interest rates under 6.6. We are expectant. We do need and want them to go lower through the end of the year. But, I honestly, we can even jump off of this chart because I want to get your take on something that I had conversations with last week, had a couple conversations this weekend, is how do we convey to the general public that mortgage rates move in anticipation of what's going to happen, not in reaction to. So, we know we got a Fed rate drop coming in September. I've had people asking me, hey, Nash, okay, well, shouldn't we wait until after the Fed drops rates before we take action? And I know better because we have a lot of history that supports, hey, that's not where we're going. But tell me, Matt, in your experience and dealing with the 3 rate drops at the end of last year and how mortgage rates responded, how are you handling those conversations?
Yeah, for me, I think, showing history is something that people understand. I mean, I understand it, right? And so I can tell somebody, hey, listen, we've got these charts that tell us how likely a rate cut is. We know, anybody else watching know, the bond market knows, Wall Street knows. So if we're 85% sure we're getting a cut, 85% of that is baked in to today's rates, not something that's going to happen on September 17th. But what I've done, Nash, I've basically told people, hey, listen, we've seen rates come down, right? 0.25 point, 0.3%. That's exactly what they did last year in anticipation of that 50 basis point cut that we got at the end of 24. And what happened was, leading up to that Fed rate cut, we saw rates go down 0.625% leading up to it. After the Fed meeting, guess what happened? And the people say, what happened? Rates went up. Like, so thinking that September 17th is going to be a magic day where this wand is waved, the Fed cuts the Fed funds rate, and then we see lower interest rates. It's just not how it works. And showing people what happened last year is hopefully a wake-up call to be like, oh my gosh, maybe all this movement we've seen down right now is all we're going to get. And history could repeat itself and rates could actually go up after the Fed meeting. Oh, I didn't realize that, didn't understand that. Yeah, that's how it happens. And, people understand if you tell them like all the data's out there, we've got a good idea of what's happening. It's been talked about at every single meeting. There's dot plots of the game plan. But yeah, it's hard to convey because, to my point about just anybody talking about this stuff, some people use the Fed rate cuts or the anticipation of them as marketing, right? Like, this is coming up, rates are going to fall, and give me a call so I can help you out. Whatever the case may be, it's a marketing ploy, and it's not based in truth, just based on how many times can I get the phone to ring.
That's an amazing tagline. Rates are going to fall. Give me a call. You just depressed me pretty good here. I decided while you were doing that, I'm like, I'm going to pull up my 1-year chart and see where were the mortgage-backed securities. And for anyone listening, like, that's where mortgage rates come from, is how much is that security yield paying? And I'm checking out September 2024. And, to your point, you can see when the Fed minutes were, when did we get these interest rate drops, or the Fed funds rate drops? And interest rate, the yields on these just surrendered 100 basis points, another 100 basis points. And we were down 250 basis. Like, it was not good for mortgage rates. But the depressing part is, this 5.5% UMBS security was yielding 1.6, like 101.61. Like, ooh, we are 170 basis points away from that right now. We're not real close. It would be super nice if, in anticipation for this, we were closer to where we were last year. But I think we have to remember last year, we're getting down into the election season, and there's a lot of uncertainty there. We've had this whole year has been shaped a lot by the tariff discussion, which has really impacted movement in interest rates, movement in the market. Traders are trying to anticipate how this is going to impact inflation going forward. And, billions of dollars moving around treasury bond markets is smart money. Like, they know what they're doing. The Fed is transparent. The Fed does not necessarily do a lot of surprising people. Like, everything that's happened this year, late last year, they may react late. And I think the Fed usually does take action a little later than they should, but they're not shocking anyone. We don't show up and have a 96% chance of a Fed rate drop and not see one, or in this case, 85%. Like, we're going to get that. They're not going to come in and drop it by 50 basis points instead of 25. This Fed is not done anything that's wild. So to your point, everyone knows what's coming. So, money is not going to wait and react. And that money is in the bond market the way that they want to be, with bond prices where they want, with those yields where they will hold. So if you're going to take action, you take action now. You don't wait for something to happen. If you want to move, you move on econ data. You move on a revision to the jobs report. You move on CPI or PPI or PCE coming in outside expectations. Those are where the surprises are, and those are where you're going to find your good low days. And that's where, as mortgage professionals, we're picking up the phone and reacting to the overreaction, because a lot of that will continue to balance out. And looking over long enough term, no major movement is expected, but there are little wins to get there. And to your point, those little wins are not going to show up the day the Fed lowers rates. It's not going to have a direct impact. So, we got to make sure the messaging is clear, so that way no one is waiting and just sitting there holding the bag while bond traders are pulling yields out of the 10-year.
Yeah, no, agree. Yeah, I think my parting words, my parting advice to people is what it's been over the last decade, is like, you just don't time things in real estate. When it comes to real estate prices, when it comes to mortgage rate, like, when you are in a financial position that it makes sense is when you purchase a home. Not like because some magic Goldilocks moment happens where home prices have come down 6% in your market and rates are going to fall by 1.5% over the next 3 months. Like, it's just, you keep waiting for that moment to happen. You're trying to quote unquote time it. You're going to be renting for the next decade, because that's just not how it works. And, to your point about being 170 basis points off, like these lows we saw last September of 6.1%, we are not close to that in any shape, form, or fashion. And so, anybody who sells you a dream that waiting a month or 2 or even 3, you're going to get a rate of 5.99 is, dreaming. It's just, it's not that close. So I think people overanalyze it, and they're trying to get super tactical because they want to feel like, they did something. At the end of the day, the smartest and most successful real estate investors that I've come across are not trying to time this. They're just doing it when they're financially in the position to do it.
Yeah, we say numbers first, story second over my branch and with my coaching. And a year ago, 10-year treasury yields 3.862. Today, 4.34. The numbers are not aligned, and these numbers don't move real fast one way or another. Short of another pandemic, we got to take everything as we see it. So you're 100% right. We'll get back together next week, talk about what all these meetings sounded like, what kind of indication the FOMC and the symposium and, Jay Powell had to say about everything. And then we'll make a new plan for next week going forward.
Sounds good. Have a good one, brother.
Take care, homie.
Bye.